I'm here today with Val McClendon, who is a qualified 401k administrator and a retirement plan advisor and consultant with QBI. QBI is a national retirement administrator based in California. And Valerie, thank you for being with us today.
Oh, you're welcome. Thank you so much for having me.
So you are based here in New England. That's your territory?
Correct.
You've spent your whole career with retirement plan design and administration for small businesses. So let's talk about solutions for small business owners. Secondly, let's talk about the trends in the retirement marketplace. And then third, how would an employer get started and where do they begin? So first off, with the recent tax changes, can you review for our viewers what are the contribution limits for 2018?
Yes, certainly. So $55,000 on an individual limit for 2018 and $61,000 if you're age 50 or older. And that is actually broken up between two different types of contributions. You have employee contributions and employer contributions. So the employee contributions have their own limit, which is the $18,500. $24,500 if you're age 50 or older. That's where that extra $6,000 of catch-up is.
And the balance is all employer contribution?
Correct. The remaining balance is all employer contribution, and that can be filled either with matching contributions or, more importantly, with profit-sharing contributions. And in my experience, people are surprised to hear that the limit can get up that large. I think when people think about 401k plans, they think of employee contributions, they think of maybe getting a little bit of match money, but there is this whole other component known as the profit-sharing contribution, and that is really how an employer can get up to their $61,000 individual limit as efficiently as possible.
So that's a good question then to follow up. So efficiency. So we work with some small business owners, maybe they're self-employed or they have fewer than 5 or 10 employees. Yeah. Does an employer have to put the same amount as everyone else for themselves?
No. We design plans that target the owners. I think many plans used to give the same percentages and profit-sharing contributions to employees, or they would make a profit-sharing contribution amount and divide it up salary proportional. But that is really a thing of the past, and that's where it should remain, is in the past. There are much more cost-efficient ways to run a plan. And if an owner is really looking to maximize owner benefits and minimize staff member cost, they're going to want to make different percentages for the owners versus employees. And of course, we have to remain within the confines of the IRS laws and regulations. So then we look to what are the factors that we need to consider to determine if this is going to be a good fit, if this particular profit-sharing design is going to be a good fit for an organization. And those factors really predominantly are age and compensation. There needs to be a disparity in age and compensation between owners and employees. And not saying that an owner has to be older than all of their employees to make this work. Generally speaking, if an owner is at least 10 years older or more than about half of their employees, we can generally limit the profit-sharing contribution for employees to about 5% of pay. And of course, the owner can get much larger profit-sharing contributions than that to fill that remaining amount, get them to their $61,000
Okay,
level.
so the old style, equal for everyone is kind of the old way of doing it.
That is archaic.
Yeah, and so now you can do things like Social Security integration or age-weighted, as you just referenced. So Valerie, what about if an owner has had a really good year and wants to contribute above and beyond the 55 or the 61,000 that you referenced before? Is there options?
Definitely. So then we would look to a cash balance or a defined benefit plan, because in those types of plans, instead of being limited to the $61,000 that you are in a 401k plan, you can get hundreds of thousands of dollars on an individual limit going into those plans. So what does that mean, hundreds of thousands? How do we quantify that amount or give some examples? As an owner gets older, the IRS allows their benefit to increase. So a 40-year-old owner can receive $111,000 in a defined benefit or cash balance plan on an individual level. A 50-year-old can receive $190,000, and a 60-year-old can receive upwards of $250,000 on an individual level.
So that's coming out, or that's what they can
That is
put
the
up?
employer contribution that is being made to the plan on their behalf as an individual.
So as you get older, you have shorter time to accumulate, so the IRS is allowing you to plow in more.
Exactly. Really allows an owner to step on the gas for his or her retirement as they age. And then we actually run that defined benefit or cash balance plan in conjunction with a 401k plan. It's not either or. And that is actually a much more cost-efficient way for the defined benefit plan to run. It's more cost-efficient to have it in conjunction with the 401k plan, and then owners can receive their $24,500 in deferrals plus profit sharing on top of those very large individual maximums. And all of those employer contributions are 100% tax deductible. So if you've got a couple of owners that are in a plan and some employees, you can get upwards of $500,000-$600,000 going into those plans on an annual level. That comes right off of the employer's tax return. So depending on what tax bracket that owner is in, you have right off the bat saved them $250,000 in taxes.
So defined benefit or DB plans are not a thing of the past?
They are not. No, they are not. They really work for small employers, mainly in the professional service industry, but can work in many industries. You just want the same principles that work for a profit sharing plan work for a defined benefit plan. So you want to have that disparity in age and compensation between owners and employees.
All right, so maybe let me take the example to a really small employer, self-employed.
Yes.
So can you have a one-person retirement plan that benefits for some of the designs?
Certainly. That's actually the best way for an employer to sponsor a plan, because then 100% of the benefits going into the plan go for that owner participant. That's known as a solo defined benefit plan. Okay. All of the limits that I mentioned remain the same. Still 100% tax deductible employer contribution, but the owner is basically the only employee that is receiving benefits. And even an owner with employees, so some owners have full-time employees that are 1099. They're not W-2 employees.
So they're not eligible.
They're not eligible. So that owner could still sponsor a solo DB plan and be the only participant that's receiving benefits in that plan.
So maybe it's a good kind of catch-up provision where they didn't fund early enough and they haven't accumulated enough. Maybe the defined benefit or cash balance is a great way to play catch-up.
Exactly.
If someone decided to add a defined benefit or cash balance option to their plan, how many years do they have to fund that? And what is the commitment? Because maybe if they have a good year one year but not so good the next year, I'm sure that's a concern.
It is. And there is a commitment level. And I make that a big part of the conversation when we start discussing with owners about whether a defined benefit or cash balance is going to fit for them. An owner is going to have to feel good about making a contribution for at least 3 years.
Okay.
Generally, a plan becomes
fully
funded.
That's what the IRS wants to see?
Correct.
Okay.
And generally, a plan becomes fully funded within about 3 to 5 years. And at that point, the employer has 3 choices once the plan becomes fully funded. They can either continue the contributions, keep making contributions, keep receiving that amazing tax benefit. They can freeze the plan, which essentially just stops the contributions, but the plan keeps going and can keep earning gains, or they can terminate the plan. And then employees can receive a distribution of their funds, either in a cash distribution, or they can roll over to an IRA so that it's non-taxable. Correct. One of the reasons that I hear most often from employers as to why they're trepidatious about starting a defined benefit plan is that commitment level. But, employers say to me, maybe we had a great 2018, but we don't know what 2019 or 2020 is going to look like. And there are proactive measures that can be taken. The key is putting those proactive measures in place prior to someone working 1,000 hours during the plan year, prior to someone earning that benefit. So right now, I'm actually contacting all of my DB plans that I set up in 2017 and discussing with the owners, how is your 2018 looking? Do you feel comfortable that you're going to be able to meet your funding requirement this year? Or do we need to talk about maybe we need to lower that contribution for you? So there's proactive things that can be done. Just like in any facet of business, it works successfully when you approach it proactively rather than reactively.
Excellent. Thank you. So let's turn now towards market trends.
Yes.
Your firm, QBI, administers hundreds, if not thousands, of plans. What are you seeing the trend in terms of matching contributions from employers?
Well, we can set a matching contribution to meet any employer's budget. So we've seen matching contributions as small as a 10% match up to the first 4% of employee salary contributed. And that may seem like a small match, but if you think about it, the employer is guaranteeing a 10% rate of return on 4% of their employee's salary. That's a pretty good rate
Free
of
money,
return.
right?
Exactly.
Yeah.
So even when there's a small matching contribution, it still is a great benefit for the employee. I think common matching contributions we see are 25% up to 4, maybe 50% up to 6, and we've seen matching contributions that are much larger than that. So
Now, can you describe what a stretch match is? I've heard that a lot, maybe for our viewers.
yes. Stretch match is a great way for an employer to kind of promote increased participation. And this is the thought process behind it. When an employee signs up for a 401k plan, they're likely going to set their contribution limit based upon what the match is. They want to contribute just enough to get them the full match, and that's it. So rather than an employer offering a dollar-for-dollar match up to the first 3% of compensation contributed, an employer can change it to 50 cents on the dollar match up to the first 6% of compensation contributed. So for the employee, at the end of the day, they're still receiving their dollar-for-dollar up to 3%, but they have to contribute 6% of their pay in order to receive that.
And the company can budget for the maximum exposure.
Correct, exactly. And that's actually a better position for the employee anyways, because they're just increasing their contributions that are going into their account for their retirement.
Yeah. Studies have shown that you really need to get to that 10% or greater contribution limit to replace retirement at income.
Exactly.
Yeah. So what about in plans that have low participation? What are you seeing with trends for there?
Well, I think it's important to discuss what issues can be caused by low participation. And when an employer has employees and they set up a 401k plan, the employees are divided into two groups. You have your highly compensated employees, which is your owner and your highly paid folks. And then you have everyone else, which is your non-highly compensated employees.
Yep.
And highly compensated people are limited to what they can contribute in the plan based on what the non-highly comps are doing. So if you have low participation on your staff member side, your owners and your key folks that are making a big difference in the plan, they're not going to be able to put in what they want to put in from their own pay. Correct. They're going to be limited. So the best way for an employer to eliminate any issues caused by low participation is to implement a safe harbor contribution. A safe harbor contribution is a contribution that the IRS allows an employer to make. It's just a type of employer contribution, and by making it, they can bypass that limitation that the highly compensated employees have. So anybody in the plan, highly comp or not, can contribute that IRS max dollar amount, that $18,500 or $24,500 that we mentioned earlier. So there's two types of safe harbor contributions that an employer can choose from. The first is a safe harbor 3%. That is a contribution that goes to anybody that's eligible to contribute in the plan. So it's not a match.
And they're 100% vested?
100% vested. It goes to anybody that's met the eligibility requirements, regardless if they're actually contributing or not. The second safe harbor is a matching contribution. That only goes to those who actually do defer into the plan. So that's a lower cost option for an employer that wants to get in the deferrals, wants to provide a great match to their employees. It's dollar for dollar up to 4%. It's a great match. And it does present a lower cost liability for the employer.
Are you seeing trends in trying to help employees help themselves maybe to get to higher deferral rates?
Definitely. So auto-enrollment has been an incredibly powerful tool for employers to use that, maybe don't offer a match or offer a little match, but they want to have that increased staff member participation. And the whole concept of auto-enrollment is that once someone has met the eligibility requirements to contribute to a plan, if they do nothing, if they don't complete an election form to either contribute or not contribute, their pay is a percentage of their pay is automatically withheld, usually about 3%, and it's automatically contributed to the plan on their behalf, which, if you think about it, a 401k plan really is for the benefit of the employees. It's to prepare them for retirement, considering the fact that Social Security is not going to be enough to sustain their expenses, just as you mentioned before. So employees need to have some type of 401k retirement savings.
So call it a nudge then.
It's a gentle nudge, exactly. And it's not forcing the employee to do anything. At any time, the employee can opt out, complete an election form to either do 0% or any other percentage. So at no point is the employee being forced to do anything. It's just really helping them to save for their
It's
retirement.
promoting good behavior.
Correct, 100%. And you can even take it one step farther with adding an auto increase feature. So with an auto increase feature, once someone has become automatically enrolled for 1 year, their percentage is bumped up 1%. So if they start with 3% being withheld from their pay, then it gets bumped up to 4% and then 5% in the next
Helping
year.
them again get to that 10% or
Correct.
greater.
Exactly.
Exactly. What about trends in terms of employee engagement? Have you seen anything?
I have. Talk to your employees about your plan. Be excited about your plan. Promote it. If an employer is not excited about their plan, employees will not be excited about it either.
Sure, yeah.
So, and I think it's also a point of making it quick and easy and efficient to sign up for the plan. Especially with millennials, they're not going to complete a piece of paper. And half the time, they're not going on a desktop. What are they doing? They're looking at their phones.
Yeah.
So mobile enrollment has been a powerful way that employers can make it easy for employees to sign up for the plan. And even offering webinars. Don't have those old enrollment meetings where everyone's stuffed into a room and uncomfortable for an hour. Offer a webinar where you can reach off-site employees, remote employees, and just makes the plan more reachable for everyone.
Well, in this day and age, you won't necessarily have everyone show up at these meetings anyhow.
Correct.
So. All right, let's move to the last area I wanted to cover. So if someone is interested in setting up a plan, maybe they either have a plan that doesn't have some of the features we talked about. Mm-hmm. Maybe they don't have the design benefits that we talked about. So how does someone get started?
I think that when an employer thinks about setting up a plan, they believe that the first right step is to contact their payroll company. Payroll company is already doing payroll. Seems like an easy transition to have them do the retirement plan. My biggest takeaway from this discussion is that an employer look into other options prior to contacting their payroll company first. And the reason is very simple. Payroll is very automated. The successful design and ongoing administration of qualified retirement plans is anything but. There are constant moving pieces. You have one feature or specification that you choose that can affect another feature or specification. And Congress is constantly changing laws. So an owner cannot expect that their payroll company is going to have the expertise to successfully design and manage their retirement plan. There are going to be issues. A couple of examples of those issues. First of all, you're not going to get any high-level plan design. The payroll company is going to try to fit the employer into the same one box, off-the-shelf product that they try to fit all of their employers into. And if you think about it, back to the beginning of the discussion, we talked about factors which have to be taken into consideration. What plan works best for an owner? What's the age, compensation disparity? These employers that are with these payroll companies, they're in all different industries. They have different numbers of employees at different ages with different compensation levels. So how all of those different employers can be fit into the same box does not make sense.
So if you can assess kind of what their end goal is,
exactly,
you can back into presenting different plan design options.
Correct.
So you mentioned that a lot of times folks will go to their payroll provider as the first place to ask about a retirement plan. Are you finding that that's a one-person contact at a payroll company, or how does that usually work?
Right. It is not. And I think that that's something that surprises owners because they think that if they have the payroll company running the plan, then they can just deal with their one payroll contact. And it's not. You have a separate contact in the retirement division. And I was actually on the phone with a payroll company that shall remain nameless with a plan that I was taking over. And the payroll contact asked the client and myself what the phone number was for the retirement division. So that, I think,
is really two different arms.
It is a clear picture that tells you how the left hand does not speak to the right hand.
Yeah, great. Now, if an employer decides they want to go forward with this, do they have to fund contributions right away, or how does that work?
The employee contributions have to be funded within 7 business days of being withheld from pay. Companies that have more employees, 100 or more, that time frame is smaller. That 7-day window is smaller. The employer contributions can either be funded during the year. Oftentimes we see that with matching contributions.
For cash flow purposes.
Correct. Or they can be funded after the year is over, just before the filing of their taxes for that year, which is where we find more in profit sharing and defined benefit. So actually, my owners that I work with are currently funding their profit sharing or their defined benefit contributions for 2017 at the moment.
Got it. So what if someone has an existing plan and they hadn't realized of all these different design features or benefits that they may not have in their plan? Is it possible to change administrative record-keeping relationships?
It is. Just because you've started doesn't mean you have to stay there. So
Okay.
QBI takes over the administration of plans for employers every year. 9 times out of 10, we can look at a document and find a better way for that plan to run, whether it be something as simple as changing the entry dates. Maybe right now they have immediate entry dates, and we change them to quarterly, so you don't have so many points of entry during the year. We've limited it to 4. It's amazing to see how the documents that I look at, they still have that profit-sharing design, that old profit-sharing design where everyone is getting the same percentage. Those still exist in documents today. So that's one of the largest changes that we make, is changing that profit-sharing design. And we will do a full review at a plan document. We will show illustrations as to what that plan could work for the employer, and that is all at no cost and no commitment.
So should a employer bring their CPA or their current financial advisor into the discussion?
Definitely. That's a very important piece. Financial advisor is going to know the employer's whole picture, and oftentimes they're going to have information about the owner's personal finances. So it's a great idea to bring the financial advisor into the picture, but you want to be careful about the financial advisor that you choose. You really want to choose a fiduciary, someone who is going to have the client's best interest in mind first, someone who has knowledge of the marketplace, and really someone who's dedicated to supporting the needs of the owner and their employees.
And so your organization can work directly with the CPA to show the different tax advantages or cash flow advantages to one plan design versus another?
Definitely. CPA is a great person also to bring into the conversation because they understand the employer's income, they understand their tax filing situation, and they're a good member of the team to be able to explain the tax advantages to their client.
Well, Valerie, thank you very much for sharing those insights with us today and our viewers.
You're welcome.
If anyone would like to get more information or learn more about your firm, how would they reach you?
Yeah, they can look on our website, qbillc.com, or contact us in the contact information provided below.